At 8:17 on Monday morning, your bank declines the $40,000 you need to start a $180,000 commercial painting job. The supplier quote is open on the other half of the screen. Primer, interior paint, protective film, lift rental, and the first delivery. 4 painters are penciled onto the schedule. You read the decline email again. Then you switch to the supplier tab and remove the materials one line at a time. The purchase order disappears. The cart returns to zero. 6 months from now, the same bank will send a pre-screened invitation to apply for a business line up to $100,000. It will not be a final approval. No money will be waiting, but today you have to answer the project manager. The property has other contractors scheduled behind you. Nobody has promised to move the sequence. You type that you cannot carry the opening costs and are withdrawing from the job. You read the message twice. Sending it changes what can happen next. Then you press send. The reply arrives the next afternoon. It is polite, short, and final. The project has been awarded to another contractor. You print the email because part of you treats paper as more official than a screen. In the shop, the crew schedule shows 3 weeks of prep, spraying, rolling, and touch-up that will no longer happen. One painter picks up a marker and wipes those 3 weeks off the board. The marker leaves a gray shadow where the work used to be. No later credit limit can put those hours back on the board. Your company is 18 months old. You have 4 regular workers, 1 aging van, a rented shop, and enough completed jobs to know that customers can love your work while your cash balance still looks unstable. The $180,000 was total project value. It was not profit, and it was not cash. Payment would have arrived in stages. Materials, insurance documents, and the first payroll had to move earlier. To you, the contract looked like future income. You could picture the walls, the crew, and the invoices. The bank could not treat that picture as completed history. 2 days later, you sit across from the branch manager. The decline letter is between you. The reasons are ordinary: limited time in business, uneven cash flow, insufficient available collateral. She does not say the contract is worthless. She says it does not replace every other part of underwriting. A customer can delay a payment. Costs can rise. A project can run behind. A signed opportunity can be meaningful without being identical to cash. It can be promising without proving that the business can absorb a bad outcome. You bring the folder anyway. The scope, estimated stages, supplier quotes, insurance requirements, and emails took weeks to assemble. You point to the contract value, then to the requested amount, because the ratio feels like the argument. You are not asking for $180,000. You are asking for $40,000 to reach the first payment. But the bank is measuring more than the chance that this job would produce revenue. It is measuring the history already visible behind the request and what would remain if the sequence broke. That difference is the insult. Your evidence is work you are about to do. Their evidence is work you have already survived. You read the lost contract as proof that the financing was necessary. The bank can read the same dependence as proof that the position was fragile. Neither side needs a villain. They are built on different clocks. Your business needs money before the evidence becomes clean. The lender becomes comfortable only after the evidence is clean. You leave with the same decline letter and no restored project. Back at the shop, the erased schedule is still on the wall. The supplier cart is empty, but the browser remembers the quote. Your crew asks what replaces the missing weeks. You do not have a satisfying answer. You only have several smaller estimates that seemed less important while the larger project was alive. You slide the unsigned material order into the project folder and close it. The folder now holds a job that was real enough to organize the company around, but not real enough to begin. The next available project is a small office repaint. It pays a deposit before materials are ordered. 4 days, modest revenue, night work. 6 weeks earlier, you might have passed on it. Mobilizing the crew for a smaller job creates its own inefficiency. Now, the shorter gap between spending and payment matters more than the headline amount. You accept it knowing it will not replace the contract. It can cover part of the empty calendar and create one completed transaction. The deposit lands Tuesday. You order paint Wednesday and move 2 workers onto the overnight schedule. The other 2 take a residential exterior job that depends on the weather. Instead of one project carrying the whole crew, the week becomes a patchwork of addresses, access codes, partial days, and separate invoices. You call each painter and rebuild the week one short assignment at a time. No one blames you in the moment. That makes the conversation harder. They need to know where to arrive and how many hours remain. The office repaint finishes without drama. The deposit and final payment appear as two clean entries in the business account. The exterior job runs 3 days late because of rain, but the customer pays promptly. A third job comes from a property manager who needs 2 vacant units turned quickly. It is less impressive than the commercial contract. It is also much easier to photograph badly. Yet each job begins, ends, and becomes visible in the account. The company is growing more slowly, but its activity is becoming easier for someone outside the business to verify. You notice the trade immediately. Smaller jobs reduce the amount exposed to any single customer, but they multiply coordination. A key ends up in the wrong lockbox. One painter drives across town for a unit that is not ready. After the first room is finished, the property manager changes the color. Every inconvenience consumes time that was never included in the estimate. Still, the checks arrive faster than the staged payments on the lost contract ever would have. You are not building the company you pictured 6 weeks ago. You are building the version that can keep moving. At the end of the third job, you sit beside the printer while it feeds out another invoice. You place the third smaller invoice beside the first two. Together, they do not add up to the $180,000 project's backlog, bargaining position, or uninterrupted crew schedule. But they produce a sequence: deposit, purchase, labor, completion, payment. A young company often has more knowledge inside it than evidence outside it. The invoices are beginning to turn private competence into records another institution can read. Credit arrives after proof. It is not an official banking term. It is not a promise about any application. It is simply the name for the timing conflict visible in those 3 invoices. Financing would have been most powerful before the larger project, when the company had the least polished history. After several smaller jobs, the records improve, but the money can no longer unlock the same opportunity. Proof is valuable precisely because it describes what has already happened. Then one customer breaks the cleaner pattern. A restaurant repaint is completed on time, and the owner approves the final walkthrough. The invoice says payment is due the following week. The week ends with no deposit. Monday brings reassurance that the payment is being processed. By Wednesday, the bookkeeper says the owner must approve it again. Thursday arrives and the client's payment still has not landed. Payroll is Friday. The company is busier than it was in the weeks after the decline, yet the account returns to the same question. Which promised dollar will become real first? You stop ordering non-essential supplies. You delay maintenance on the van for another week. Neither choice is catastrophic. Both show how little distance separates normal operations from a cash squeeze. You move the payroll envelope to the center of the desk. It is not literally full of cash. It holds printed timesheets and the total that must clear. The papers turn an abstract balance into 4 households expecting the hours already worked to become money. The restaurant eventually pays, but only after the delay has reorganized your attention for 8 days. The late payment does not arrive with an apology or an explanation. It arrives after 8 days. It changes how you remember the bank meeting. You still resent losing the large contract, but now you can see the downside question without agreeing that the decline was the only possible answer. If one small customer can redirect an entire week, the project you lost could have magnified both the gain and the strain. That does not prove the bank was right. It proves the contract value alone could not settle the question. The future income you pictured carried timing risk at every stage. Loss makes that distinction hard to hold. The project you lost stays intact in memory because you never lived its delays, change orders, damaged surfaces, or disputed invoices. In your head, it performs exactly as planned. The smaller jobs feel messier because you actually survived their problems. That is counterfactual thinking shaped by loss aversion. The surrendered opportunity can look cleaner than the reality that replaced it. Your anger is understandable. It can also quietly convert a possible future into a guaranteed one. Meanwhile, the account records what memory cannot. 1 month closes, then another. Deposits become more regular. The lowest balance is still uncomfortable, but it does not fall as sharply. Vendors are paid. Payroll clears. A few customers pay late, and the statements keep those interruptions too. By the 6th statement, the company has not transformed into a perfect borrower. It has simply produced 6 more months of observable behavior than it had on the morning of the decline. The SBA notes that established businesses develop operating history, business accounts, credit reports, and internal financial statements that funding providers may use in evaluation. 6 months does not guarantee approval. Not every lender reads the same record in the same way. It only explains why time can change what is available for review, even when the owner's skill has not suddenly changed. Your brushwork did not become more trustworthy in month 7. The record surrounding the brushwork became longer. The Federal Reserve's 2023 Small Business Credit Survey places both numbers in a recognizable range. Half of applicant firms sought $100,000 or less. 30% sought $50,000 or less. Those figures describe the survey sample. They do not describe what your company should receive. They matter here for one narrow reason. A $40,000 request and a marketing ceiling of up to $100,000 are both plausible small business numbers, but they represent very different claims. The same report shows that approval outcomes vary with risk category and institution type. Small banks approved at least some financing for 75% of applicants. Large banks did so for 66%. Lower-risk firms had better outcomes than firms presenting medium or high credit risk. These are broad findings, not an underwriting formula. They show that a lender's response can change when the visible risk state changes without proving that any earlier decision was correct. Your relationship with the bank becomes more legible too. More than 2/3 of bank applicants in the survey named an existing relationship as a reason for applying. A relationship is not a promise of approval. Here it means the bank can see deposits, payment patterns, average balances, and the survival of several uneven months. The bank never watched you paint a wall. It watched the financial trace left by the jobs. The trace is incomplete, but it is no longer thin. 6 months after the decline, a thick envelope from the same bank arrives. The outside says your business has been pre-screened to apply for a line of credit up to $100,000. The larger number sits in the largest type. For half a second, your body reacts before your reasoning does. You feel chosen, then confused, then angry. The company needed less than half that amount when a specific contract was waiting. Now, no comparable project sits on the schedule, and the bank is offering a number larger than the request it rejected. You pull the old decline letter from the bottom drawer. It is still clipped to the supplier quote because you never decided where else to put it. The reasons have not changed on the page. Limited operating history, variable cash flow, insufficient available collateral. You remember the erased schedule and the calls to your crew? Then you remember pressing send on the withdrawal email. The new envelope does not feel like an opportunity at first. It feels like evidence arriving for an argument that ended 6 months ago. You place the invitation beside the rejection and compare the two amounts. $40,000 declined, up to $100,000 invited. From across the room, the pairing makes the institution look absurd. Up close, they make different statements at different times. The first responds to a completed application with the information then available. The second markets the possibility of another application, built from newer screening data. The emotional contrast is real. The financial meaning is not that the bank reversed its old decision and handed you a larger line. Then you read the small print beneath the larger number. Approval remains subject to an application, review, eligibility, and final terms. In plain English, you have been invited, not approved. You may apply and receive less. You may receive nothing. Up to describes a ceiling in the marketing, not a balance sitting behind a button. That clarification does not erase the timing, it sharpens it. The invitation can be conditional and still show that your company now looks worth contacting. 6 months of deposits, paid vendors, completed jobs, and low balances you survived change the inputs. The institution has not apologized because it does not experience the erased schedule as you do. Its message changes when its record of you changes. The human consequence stays attached to the earlier state. You call the branch manager who explained the decline. You do not accuse her of hiding an approval because the letter says no such thing. You ask why the bank is soliciting a larger application now. She explains that marketing selection and final underwriting are different processes. An updated account activity can affect who receives an invitation. She cannot promise an outcome. The answer feels procedural and thin, but it fits the documents better than the version where the bank suddenly discovered it had been wrong. After the call, you imagine reopening the old contract with the new letter in hand. The fantasy lasts a moment. The property has been painted. Another contractor bought the materials, scheduled the labor, handled the problems, submitted the invoices, and collected whatever profit remained. Even a fully approved line today could not move time backward. Credit can expand future options. It cannot recreate a customer deadline, an available building, or 3 weeks another company has already worked. The lost contract also cannot prove what would have happened if the $40,000 had been approved. Perhaps the project would have launched cleanly and changed your scale. Perhaps a delayed stage payment would have created a larger squeeze. Perhaps the client would have shifted the scope. The point is not to replace the bank's certainty with your own. Opportunity decisions must be made before their outcomes become evidence. By the time uncertainty disappears, the decision is gone. That is the cyclical pressure hidden inside the story. A business with short operating history and uneven cash flow may need financing precisely because it has not yet accumulated the stability a lender prefers to see. If it survives on smaller jobs with faster payments, the record improves. Improved records can affect later credit decisions depending on the institution and the application. But capital that arrives later follows the slower growth the company already endured to produce the proof. Different businesses meet this tension differently. An owner with more personal assets, a longer operating history, stronger customer deposits, or more room between payroll and receivables may cross the gap with less damage. Another owner may have excellent technical skill and still face a thinner margin for timing errors. That difference is not a ranking of discipline or deservingness. Financial systems observe some forms of resilience more easily than others, and observable resilience often comes from resources accumulated before the current opportunity appeared. You look again at the 3 smaller invoices. They did more than generate revenue. They kept workers partially scheduled, created deposit history, extended vendor relationships, and made the account easier to interpret. They also cost you nights, extra driving, fragmented days, and slower growth. A clean statement can be the residue of months that felt unstable while you lived them. The tidy page does not show every call, delayed repair, weather check, or anxious Thursday that produced it. The invitation may still become useful, or it may not survive final review. This story does not need that question answered. Treating the mailer as guaranteed money would repeat the same mistake as treating the $180,000 contract as guaranteed cash. Both point toward possible future flows. Neither removes execution risk, underwriting conditions, customer behavior, or time. The reversal is narrower. The business becomes more attractive to contact after demonstrating that it can operate without the money it once urgently needed. You reopen the old project folder and add the new mailer. The folder holds the scope, the supplier quote, the decline, the withdrawal message, the awarded elsewhere email, and the invitation to apply for up to $100,000. The papers tell a complete story only together. Remove the decline, and the invitation looks flattering. Remove the invitation, and the decline looks final. Remove the lost contract, and neither document shows what timing cost the people who lived between them. There is no lesson that banks should approve every applicant at the moment of greatest need. Need alone does not erase risk, and a large contract value does not make every request safe. There is also no lesson that the later invitation proves the system worked perfectly. The system grew comfortable with evidence that took time to produce. Your business paid for that time with a slower path, a lost project, disrupted schedules, and months spent converting ability into records. You place both bank letters on top of the awarded elsewhere email. The first says the company did not yet offer enough support for $40,000. The second says it may apply for up to $100,000, subject to another review. Between them sits the opportunity that could not wait for either side to become certain. The bank learned to trust the numbers. The opportunity had already stopped waiting.